All right, today we are diving into Cintas Corporation. Ticker is CTTS. We're looking at their fiscal 2026 second quarter earnings.
Yep. And our mission here is pretty simple. Cut through all the noise. Cintas put up some really great numbers, but the market's reaction was a little muted.
Right. It was positive, but not, explosive. And that tells us there's nuance here, something we need to dig into, especially around the margins and what's coming down the pipe.
Exactly. So we're skipping the line-by-line report and jumping straight to the core insights.
Perfect. So let's start with that snapshot. Did they deliver? And I guess, but how much?
Oh, they absolutely delivered. A clear beat on both the top and bottom lines. Total revenue hit $2.8 billion.
2.8. And what's the growth on that?
That's up a really robust 9.3% year over year. And it beat the Wall Street consensus by about $30 million.
Okay, a solid beat on revenue. What about the bottom line? Profitability?
Just as solid. Diluted EPS came in at $1.21, just squeaking past the $1.20 consensus.
A penny beat. But that, combined with the revenue, was enough for management to come out swinging in their remarks, right? I saw quotes about record revenue.
They did, but honestly, the more important phrase they used was all-time high operating margin.
Oh, yeah.
When a company like this, in a tough, route-based business, can say that, it tells you the real star of the quarter was just pure operational execution.
And yet, despite that great language, the stock closes up, 1.34%?
Exactly. And that gap, between the stellar report and the sort of lukewarm investor hug, that's where we need to focus. It signals there were some real concerns raised later on in the call.
It forces us to look past the headlines and ask, okay, how do they get that margin expansion? And more importantly, is it sustainable?
That's the question.
So let's zoom in on those margins, because that feels like the core story. Gross margin expanded 60 basis points, hit 50.4%. But that operating margin number, an all-time high of 23.4%, is pretty striking.
It is. And this wasn't some, accounting trick or one division just having a blowout quarter. Management made a point to say their two largest route-based businesses also hit all-time high operating margins.
So the efficiency is systemic. It's baked into the culture.
Deeply embedded. You can see it in the segments. The biggest one, uniform rental and facility services, brought in about $2.15 billion.
Growing at what, 8%?
8.3%. And its gross margin, 49.8%, was its second highest ever. They are just running at peak efficiency.
And the other segments?
They actually grew even faster, up almost 13%. The first aid and safety business in particular, its gross margin was 57.7%, which tied its own all-time high. The theme is just they're maximizing every single dollar.
And this wasn't just acquisitions, right? The organic growth is the real engine.
For sure. Organic growth was strong at 8.6%. Acquisitions only added about 0.7%. So this is homegrown success.
Okay. So what's fueling that engine? Management had to have given some color on that?
They did. And the number one thing they pointed to was customer retention.
Which is the ultimate report card on execution.
Absolutely. They said retention rates are at an all-time high right now, and they link it directly to execution, culture, and interestingly, their investments in technology.
Okay, good culture is easy to say, but where does the tech come in? What are they doing specifically?
They called out platforms like SmartTruck and some AI initiatives. And if you think about it, it makes sense. Optimizing routes, predicting when a customer needs more soap before they even call.
Making the whole process frictionless.
Exactly. You make the service that reliable and that easy through tech, the customer has no reason to leave. That's the direct link they're drawing.
And they're still pointing to that huge no-program total addressable market, or TAM.
It's massive. Over 16 million businesses in the U.S. and Canada that don't have a formal program. And here's the kicker. Over 2/3 of their new customers are coming from that pool.
So they're not just in a knife fight with competitors. They're actually creating the market by converting people who used to do it themselves.
They're proving the value prop of outsourcing, and they gave a really great concrete example of that in the Q&A.
Oh yeah, the property management company. It really brings the model to life.
It's a perfect anecdote. So they were already providing basic uniforms to this company's maintenance staff, clean shirts, pants.
Standard stuff.
Right. But during their regular visits, the Cintas driver notices the customer is just struggling with restroom supplies, toilet paper, soap, paper towels.
Struggling how? I mean, don't most companies just order that stuff in bulk online?
They do. But think about what that means. You're tying up cash in inventory. You need a big storage closet, which is a valuable real estate for a property manager. And you're paying your staff to count rolls, place orders, and stock shelves. It's a hidden drag on efficiency.
Okay, I see where this is going. Cintas steps in with their hygiene program.
And just takes the whole problem away. The customer converts all that unpredictable spending into one steady, budget-friendly service fee. They get their storage space back, and their maintenance team can now focus on, actual maintenance.
Not downing toilet paper.
Exactly. And that's the compounding effect. They start with uniforms, add on mats, then hygiene. That's the engine. That's how it becomes so sticky.
Which brings us perfectly to the investor side of this, the outlook, the headwinds. The reason the stock didn't pop more. Let's start with the good news. They raised the full year guidance.
They did. Revenue guidance is now up to between 11.15 and 11.22 billion, and they bumped the EPS range to between 481 and 488, so a vote of confidence.
And that confidence seems to be showing up in how they're using their balance sheet. Capital deployment looked really aggressive in Q2.
Highly aggressive. I mean, they spent about $86 million on small strategic acquisitions, but that wasn't the headline.
The buyback was the headline.
To Buyback, they spent $622.5 million on share repurchases.
Wow. $622 million. For one quarter, that's huge. That screams that management thinks their stock is a bargain.
It was their third largest quarterly buyback ever. All in, just in the first 6 months of this fiscal year, they've returned $1.24 billion to shareholders.
They're clearly flexing their financial strength.
No question. But here's where the caution from investors starts to creep in.
Okay. First up, the guidance implies they're facing tougher comparisons in the second half of the year.
Right. Last year's second half growth was about 90 basis points higher than the first half. So to hit this new guidance, they actually have to accelerate against a harder backdrop. It's doable, but it's a higher bar.
But that's not the big one. The real yellow flag for investors, I think, was the tech overhaul discussion, the ERP system.
The ERP flag, yes. The SAP FHIR implementation in their fire protection business.
So what did they say that would spook the market so much? System upgrades are supposed to be a good thing long term.
The long term is fine. It's the short term cost. They warned about incremental costs hitting now, and they specifically flagged a potential 100 basis point margin headwind.
100 basis points.
A full percentage point of margin compression, specifically in the fire business, coming in fiscal 2027. So investors hear all-time high margins now, but then they immediately hear guaranteed margin compression next year. And they hate that.
That's a big number for one segment. And it does raise a question. If you know you have this big expense coming, why execute your third largest buyback ever right now? It seems like a conflict.
It's the question analysts are definitely asking. Management's view is, look, our balance sheet is clean, leverage is super low, we should be opportunistic. But you're right, it's a tension between boosting the stock now and insulating for guaranteed costs later.
And what about external costs? Tariffs? Inflation? How are they handling that?
This was a really critical point. Management was explicit. They will not just rely on price hikes to offset cost pressures.
That's key for keeping that record high retention.
It's everything. Their strategy is, one, sourcing diversity. They said over 90% of their products have at least 2 supply options. And 2, just relentlessly extracting inefficiencies from their own operations. They know it's a competitive market.
Okay, last piece of the puzzle. The macro view. Any concerns about a softening labor market hitting demand for uniforms?
They had a really sharp answer for this. They acknowledged the data, but they argued the job losses we're all reading about are mainly in white-collar sectors.
IT, finance, back office jobs.
Exactly, not their core end markets, the people who actually wear a Cintas uniform for work. Those jobs are more stable.
So the frontline worker is still working?
Pretty much. In fact, their key target verticals, think healthcare, hospitality, government, those are all growing faster than the company average right now. They feel they're well-positioned against a white-collar slowdown.
All right, let's shift gears. It's time for our not financial advice segment. Standard disclaimer applies here. This is purely analysis and entertainment based on the facts from the call, not a recommendation to buy or sell anything.
And based on everything we just covered, the rationale for this idea really comes down to the balance sheet. I mean, the company's running with super low leverage, well below 1 time, and they just proved they're willing to get aggressive with that massive buyback.
So you've got a pristine balance sheet, tons of cash flow, and management themselves saying M&A is lumpy, which sounds like code for we're waiting for the right big deal.
It's a loaded gun. So the pitch is what I'm calling a leveraged leap strategy.
A leveraged leap. I like it.
Given their history and their current financial position, the trade would be to go long on Cintas shares, or if you're feeling more aggressive, call options with a 6 to 9 month expiration.
So you're not betting on that steady, predictable organic growth.
Yeah.
You're betting on a surprise.
You're betting on a non-linear event. The catalyst here isn't the next earnings report beating by a penny. The catalyst is the surprise announcement of a major non-tuck-in acquisition, something that really moves the needle.
Or a return to that $1 billion plus quarterly buyback we've seen in their past.
Exactly. That kind of sudden, massive capital deployment would force a PE re-rating pretty quickly, especially if they hold up against those tough second-half comps. It's a bet on management's opportunism.
The risk, obviously, is that the market stays fixated on that FY 2027 ERP margin headwind, and the stock just kind of treads water.
That's the risk. But the reward is a sudden surge that blows past any organic growth model. It's a bet on the balance sheet, pure and simple.
All right, let's wrap this deep dive up. The core message seems to be Cintas delivered fantastic execution. We're talking all-time high margins, a guidance raise, record customer retention.
All backed by smart tech investment and very disciplined, aggressive capital return. But you have to put that in context.
The context being tougher comps coming in the second half, and that very specific, very real ERP cost headwind coming in FY 2027 for the FHIR segment.
It's a necessary investment, but it's a costly one that you have to keep an eye on.
And all while they're committed to not just jacking up prices on customers.
Which brings us to the final provocative thought for you to chew on. Given that absolute commitment to absorbing costs through their own efficiency, not through price hikes, how long can they balance that?
What do you mean?
How long can they navigate these significant internal cost headwinds from the ERP system without eventually having to compromise on the operational excellence that got them these record retention rates in the first place? That balancing act between internal cost and external customer experience, that is the whole game.
And that's what we'll be watching for in Q3. Something to keep at the top of your list. Thanks for joining us for this deep dive. We'll catch you on the next one.